There's some positive economic developments as the BankServe Africa take-home pay index reflects a third consecutive month of growth. That's as the nominal figure for September has recorded a 4.1% rise. Economist Elize Kruger joins us now to go through the index. Good morning to you, Elize. Welcome news. Talk us through the highlights of this particular reading.
Yes, indeed, Tumisang. It's good news that salaries have at last started to move or to remain a bit higher than what we've seen over the past 12 months or so. So those three consecutive monthly tick-ups resulted now in our Q3 nominal take-home pay being 6.8% above Q2, and that is a sizable about 1,000 rand differential if you do the sum. So yes, indeed, if we can see this to prevail, into the next months, it will start to have a meaningful impact on the finances of households, of salary earners, because as we know, all the factors that have been pressurizing the middle class, the salary earners are still with us. We still have elevated interest rates. We still have high cost of living. We still have, regular load shedding and the cost of that on households. So all of those factors, I want to say, still with us. But it seems like there are more and more industries that have become more resilient to the difficult economic environment, so they're starting to grow despite that, and then also open up a bit more space on the wage side, to remunerate workers with more CPI-related salary increases.
Let's delve into those industries that have provided a positive contributing factor with regards to this index. What are they doing right?
Well, I do think what we have seen is that many of the industries have started to mitigate against load shedding by getting their own power generation, options, as opposed to be just dependent on an Eskom and then have to be hit hard by load shedding every time it so often happens. So I think that mitigation against load shedding has resulted in production numbers being slightly higher than what we've seen in the recent past. So as long as you can keep your doors open and keep operating and keep trading while you've got load shedding, you've got a better chance, and obviously profitability-wise, you are doing better. So from that point of view, I think that is what we are starting to see, that resilience that we've read about, in many of the recent financial reports as well, that is starting to filter through into a slightly better scenario for the wages.
Now, Elize, what does this mean for the household? We know that spending has been dwindling as a result of the pressures that we are experiencing due to the cost of living. This then becomes some sort of relief.
Yes, a marginal alleviation, I would say, to Misang, because if you really look at it in a sort of an annual basis, we're now zooming a bit into the last quarter where things are looking up quite a bit, and we hope this could sustain. But if you look at the year as a whole, and if you compare to last year, yes, indeed, I think we are looking at somewhat better salaries in 2023, so that helps a bit. But inflation-wise, we're also still looking at an average for this year of about 5.96% compared to last year's 6.9%. So it is still high. It's still closer to the upper end of the Reserve Bank's target band. And if you look at the specifics in terms of food prices, and even fuel prices with renewed pressure, upward pressure there, there are still a lot of pressure on the finances, and there's still an erosion of purchasing power due to inflation. So it's a marginal improvement in the quarter, and we hope it could prevail. And then hopefully it will also coincide with a further moderation in CPI into next year. But unfortunately, the recent fuel price hikes and recently announced medical aid premium increases for next year, all of those still point to upward pressure on inflation. And we're not completely out of the woods in that regard.
Oh, absolutely not out of the woods. And you've highlighted on what could hamper the growth that has been recorded over the past three consecutive readings. Going forward, though, the near-term outlook with regards to negative as well as positive contributors, what are the most immediate?
Yes, I think in the short term, I hope that we will see this continuation of better nominal wage increases. However, in terms of the real side, as you alluded earlier, that in real terms it's not as positive as in nominal terms, given this impact of inflation I spoke about. And on inflation looking forward, we've had our most recent data point at 5.4% for September. And I do think we're going to be stuck in the range between 5 and 5.7 in that order for at least, 9 to 12 months. So we're not going to see inflation, moderate significantly below 5% anytime soon. So that would mean that, to have a better outcome for you as a salary earner / household in terms of spending, that you need a salary increase on top of that. And that will be still, I think, a big ask in an economy that is growing less than 1% as we speak. This year, maybe next year, we could look at a slightly better growth rate, but there are still, I would say, harsh economic conditions out there, and it will still be a difficult environment for salary earners in the next while.
Thank you so much for your contribution. Economist Elize Kruger there talking us through the latest BankServe Africa take-home pay, which has seen a third consecutive improvement.